I'm Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. You're probably familiar with what a mutual fund is, and you've likely also heard of an exchange-traded fund, or ETF. While mutual funds and ETFs kind of look and act the same, there are some important differences between them. I'm about to explain what those differences are and why they matter. But before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. The similarity between mutual funds and ETFs is that they're both forms of pooled investment vehicles. Pooled means you and every other investor who buys the fund literally pool your money into one big pot. And then that collective pot of money is used to buy dozens, if not hundreds, of individual stocks or bonds. The benefit of pooling is that it gives you the ability to get a lot of investment diversification cheaply and easily. For example, assume you want to get exposure to the S&P 500, which is the index that tracks the performance of the 500 largest companies whose shares trade on US exchanges. If you only have $1,000 to invest, it would be impossible to buy all 500 stocks in the index because you simply wouldn't have enough money. But by investing in a pooled investment vehicle like a mutual fund or ETF, you and thousands of other investors all combine your money into a much larger pool of buying power, and that pool is large enough to invest in all 500 stocks. So, what do you own when you own a mutual fund or ETF? Technically, you own a prorated share of an entity that in turn owns that single pot of assets. Therefore, you indirectly own the economics of each of the underlying investments in the fund, which is how your relatively small amount of investment can get you exposure to hundreds of individual securities. That's the benefit and power of investing through a pooled investment vehicle. And both mutual funds and ETFs provide that same access. So that begs the question, if mutual funds and ETFs basically do the same thing, why would I invest in one over the other? Well, that's a great question. And the answer is going to depend on how the differences between the two impact you and your investing needs and preferences. Let's walk through the main differences. First, what are the differences in investment strategies between mutual funds and ETFs? Well, a large portion of mutual funds are what's called actively managed. This means the portfolio managers who run the fund will actively filter through and try to pick stocks or bonds they think will perform well over time. Ideally, the goal is to pick securities that will perform better than their respective benchmarks or broad market indices. The opposite of active management is passive management. Passive means the strategy of the fund isn't to attempt to separate future winners from losers and try to invest only in the expected winners. Instead, the fund simply tries to mimic or track an index such as the S&P 500. The strategy is called passive because the fund manager basically just invests the fund in whatever stocks are in the index. Occasionally they'll need to do some buying and selling in the fund, like when one company leaves the index and another takes its place. In that case, the fund will need to change its investment holdings accordingly. Otherwise, that's about it. The investment strategy is pretty hands-off. In other words, it's passive. Many mutual funds offer active strategy, while others offer passive strategies. As for ETFs, they've historically been almost exclusively passive. However, there are some ETFs that are active, and that number is slowly increasing. So if you're looking for an active investment strategy, chances are you'll need a mutual fund. But if you want a passive strategy, you're likely to find what you're looking for in either mutual funds or ETF form. Let's next look at the differences in fees. Most mutual funds used to have a sales commission known as a load. For example, if a fund had a 5% upfront load and you put in $100, $5 would be paid to the fund company as a sales commission, and only $95 would actually get invested in the fund. Thankfully, many mutual funds have since become no load, meaning they don't have these sales commissions anymore. But believe it or not, many funds still have loads and people still buy them. To each their own, I guess. Mutual funds also have management fees, which is a fee paid to the fund company to compensate their portfolio managers and pay for the resources necessary to run the fund. Mutual funds may also have something called a 12b-1 fee, which is basically an extra charge the company hits you with so they can pay for the distribution and marketing of the fund. And finally, mutual funds may also have some generic other fees to cover administrative costs perhaps. Now all said and done, the management fee, 12b-1 fee, and other expenses are typically wrapped up into a single fee called the fund's expense ratio. That's the total amount of fee deducted from your account each year. You don't have to consciously or separately pay it. Instead, the fund company automatically deducts the expense ratio from your account balance, typically each quarter. The total expense ratios for mutual funds varies a lot, and part of that depends on whether the fund has an active or passive investment strategy. Because all else equal, it's a lot more work to run an active strategy than a passive fund, so the expense ratios for active funds will be higher than for passive. The total annual expense ratio for actively managed mutual funds ranges typically from about 0.5% to 1%, though there are some active funds whose expense ratios are above or below that range. For passive mutual funds, the fee is much less, commonly under 0.25%. As for ETFs, they don't have any sales loads or 12b1 fees, so that right there makes them lower cost than mutual funds. They'll generally only have management fees and potentially some other expenses. So on average, their expense ratios are lower than those of mutual funds. That's also largely because their strategies are typically passive instead of active, so the management fee portion of the expense ratio will be smaller. ETF expense ratios are often below 0.25%. Some now even have zero ongoing fees or expenses. The next main difference between mutual funds and ETFs is how they're traded. When you buy a mutual fund, you ultimately buy it directly from the fund company who manages it. And when you sell it directly back to them. You don't actually sell it per se, you instead redeem it. Because the fund company doesn't actually buy your fund interest back. They basically just liquidate from the pool of investments enough cash to pay you out. You can also buy a mutual fund through a third-party broker, but ultimately behind the scenes, that broker is basically just acting as a middle person between you and the underlying fund company. When you buy a mutual fund directly from a mutual fund company, they won't typically charge you any purchase fee. I'm not referring to a sales load here, I'm instead referencing a separate purchase fee. Things are often different when you close out your position though. When you redeem completely out of a mutual fund, you do often have to pay an account closing fee to the fund company. That fee is usually fairly modest though, typically $25 or maybe $50. And then if you buy or sell a mutual fund through a third-party broker, that broker is likely to charge you their own transaction fee, which may also be something like $25 or $50 per trade. As for ETFs, this is where they really start to differ from mutual funds. You don't buy or redeem ETFs directly from or to the fund company. Instead, ETFs trade like stocks where you buy and sell them on a stock exchange through a broker. Unlike mutual funds where you can only trade them once per day at the end of the day, you can buy and sell ETFs throughout the course of the trading day. Most brokers used to charge a per trade fee to buy and sell all ETFs and stocks. Now, almost all major brokerages got rid of their trading commissions for stocks and ETFs. Therefore, you most likely won't have any trading fees to buy or sell ETFs at this point. The next difference is how mutual funds and ETFs are valued. Mutual funds are only valued once per day at their closing net asset value, or NAV. NAV is basically just the price of your slice of the whole pool's net assets. And the pool's net assets is simply the sum of everything the fund owns minus the sum of every debt or liability the fund has. Recall that when you buy or redeem a mutual fund, you can only do it once per day at the end of the day. Now, you can put your order in at any point in the day, but the price at which you buy or redeem your holdings will always be at the end of day NAV, no more, no less. ETFs are quite different. Because they trade through a stock exchange and you can buy and sell throughout the day, the price at which you buy and sell is not going to simply be the NAV. Instead, it's going to be at whatever bid or ask prices the market demands. Bid price is the price that buyers are willing to buy the shares, and ask price is the price at which sellers are willing to sell the shares. This is how all exchange-traded products work. It's basically supply and demand pricing amongst the buyers and sellers. In many cases, particularly for the large and actively traded ETFs, the prices at which you buy and sell aren't too different from one another, and they don't typically deviate too much from what the fund's hypothetical intraday NAV would be. But, especially with some of the smaller ETFs where there are less market participants looking to trade them, there could be big differences in the buying and selling prices, and those prices could be quite different from what the fund's NAV should be. So you have to be careful about this potential divergence in pricing in ETFs. This is referred to as illiquidity, which means there could be big differences in bid and ask prices or buy and sell prices throughout the day as there are only a limited amount of interested market participants. Finally, there's a difference in taxation between mutual funds and ETFs. All else equal, ETFs are more tax efficient than mutual funds, particularly when held in a normal brokerage account. With both mutual funds and ETFs, you will have to pay tax on any capital gain you have when you sell your position, if it's in a normal brokerage account. As an example, if you buy the fund at $20 and eventually sell it for $30, you will have a taxable gain of $10 in the year you sell it. Or if you sell it at a loss, that loss will potentially reduce your tax bill for that year. The tax treatment is different if you own the fund in a Roth account or a tax-deferred account, as there will be no tax impact within those accounts until you eventually withdraw money. Also, while you hold your mutual fund or ETF, they will most likely pay dividends or interest to you during the year. Recall that when you own a pooled investment vehicle, you indirectly own all the underlying stocks and bonds owned by the fund. So when those underlying stocks and bonds pay dividends or interest, those payments are passed on to you. From a tax perspective, if you hold your fund in a normal brokerage account, those dividend and interest payments you receive will be taxable in the year you receive them. Now here's where mutual funds and ETFs really differ from a tax perspective regarding taxation of the sale of securities within the fund. With an actively managed mutual fund, the fund will be buying and selling stocks and bonds throughout the year. If the fund sells positions at a gain, those gains will be passed on to you, the fund owner. And even if you leave those gains invested in the fund, meaning you don't pull them out and do something else with the money, you will still have to pay tax on them in the year they occur, again assuming you hold them in a normal brokerage account. Not only will mutual funds sell some of their holdings in normal course of buying and selling and rebalancing the portfolio, but they may also have to sell positions to meet redemption requests from other investors. Because remember, you don't actually sell a mutual fund when you want out. Instead, you directly redeem it from the fund company. That means they essentially have to sell some of the stocks and bonds inside the fund to generate the cash to pay you out. All the investors in the fund will have to realize a prorated portion of all those underlying sales. This all means mutual fund investors basically will have no control over when they're forced to realize taxable gains on their holdings. On the other hand, with ETFs, there are rarely any taxable gains within the fund passed on to investors. This is for two main reasons. First, because ETFs are typically invested in passive strategies that don't frequently buy and sell their positions, there's going to be a negligible amount of underlying stock and bond sales in the first place. And second, when investors in ETFs want to get rid of their position, they simply sell it into the market through a broker. It's not like a mutual fund where the only way out is to directly redeem it with the fund company. So in the case of an ETF, the fund company doesn't need to liquidate any of the fund's holdings to generate the cash to pay you out. Because when you sell it, another market participant is buying it as is. It's not getting returned or liquidated to the fund company. All said and done, if you're going to be investing in pooled investment vehicles in a normal taxable brokerage account, ETFs are almost certainly going to be more tax efficient than mutual funds. Well, that's it for the main differences between mutual funds and ETFs. I hope you found this video helpful. If you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes in Retirement, where you can get answers to all your retirement-related tax questions. Thanks for watching. I'll see you soon.